Recently I talked about how Dr. Martens got destroyed by its woke mentality. And recently, in the past few years, a lot of companies are going woke. Even more in the fashion sector. Recently, Jaguar went full woke with an horrible advertisement. And many brands like Gucci, for example, have been transformed into woke brands. But there is a kind of small German brand which is holding up. They are not going woke yet. And recently the stock took a nice plunge from 44 to 32 in just a few weeks. The stock I'm going to analyze today is Germany's best fashion brand, which is Hugo Boss. Welcome back to a new video. I am the Italian investor and today I'm going to analyze Hugo Boss. But before we start, please remember to subscribe to my YouTube channel and leave a like if you like this type of videos. Thank you very much if you will. So, Hugo Boss is a pretty famous fashion brand which sells products under the brands Hugo and Boss. Hugo is the more mainstream brand aimed at youngsters, while Boss is the more elegant one, which recently announced that David Beckham became brand ambassador. In the past few years, this company made a very good job with advertisement and marketing. They've been really good at using the right influencers to make the brand more famous. But now let's take a look at the company's numbers. Revenues have been growing pretty well in the past few years, from 2.8 billion euros in 2015 to 4.2 billion euros in 2023. But unfortunately, gross margins and operating margins have been worsening. This is probably the biggest problem of this company. They are not doing a good job at handling costs. But management has announced some measures to reduce costs and handle them a little bit better. For now, they are not doing an incredible job, but they surely have the possibility to get to better operating margins. The brand sells very good products at pretty high prices, but not as high as bigger brands. So diluted EPS has actually been going down. But in my opinion, from now on, they could actually be able to improve these operating margins, which are getting worse and worse. Analysts believe that EBIT margin can improve in the next 5 years. I don't know if it will improve so much, but that's the goal of the company. They believe they can reach an EBIT margin of around 12%, and it's absolutely doable. It's not such an incredible operating margin. They're just gonna have to improve at handling costs. And keep in mind that most of this rise in costs is due to depreciation and amortization. This is because the company keeps on opening new shops and they can open many more in the next few years. So this is something that maybe the market is missing. As you can see, depreciation and amortization more than tripled from 2015 to 2023, while in the same time period, capital expenditures only doubled. If you follow Warren Buffett, you will know that to value companies he likes to use owner earnings, where depreciation and amortizations are added to net income, but you have to subtract maintenance capital expenditures. That's because depreciation and amortization aren't a real cash expense. Therefore, this worsening EBIT margin is actually not as bad as it looks, because it's driven by depreciation and amortization, which are simply arising from the opening of new shops which are profitable, which are making money. So the company is simply investing for its future, but right now they're having a setback due to this hugely growing depreciation and amortization line. And talking about shops, we have to say that the possibility of expansion are still enormous. This company is still relatively small. They are fairly big in Europe, but they are still very small in the Americas and in Asia Pacific. For example, China is only 5% of their revenues. This means that this brand could expand and grow a lot in the Americas and in Asia Pacific, mainly in China. And needless to say, this could mean huge revenue growth in future years if they use a good strategy. So maybe, and just maybe, the market is getting blinded by This operating margin weak performance, which is driven by a non-cash expense, which therefore perhaps is a little bit confusing, let's call it. Probably the actual cash flow generation of this company is higher than what the market perceives. And still, even with this bad operating margin, the stock is trading at a 8.5 price earnings ratio, while the next 12 months price to free cash flow is only 7.2. A very low level, in my opinion. This stock should probably trade at around a 15 price earnings ratio, maybe even higher if they will be able to improve their operating margins. So this stock could be pretty interesting for the future given its low valuation, the bad perception of the market of this company, and the possibility of growth in the Americas and in Asia. Furthermore, an interesting fact is that Frasers Group, a UK company, is buying a lot of shares in Hugo Boss. Right now they own around 20% of the company, and perhaps they could raise this stake, giving some support to Hugo Boss shares. And who knows, perhaps they could acquire the whole company someday. That's it for today. Please let me know what you think about Hugo Boss, type a comment, remember to leave a like and subscribe to my YouTube channel if you're new. See you next time. Bye!